convene as well as connecting people with research and data. We play an important role creating spaces where different stakeholders convene. Discuss the challenges and opportunities facing their communities, and share best practices. Ensuring all communities in our nation have access to affordable credit. Richard H. Clarita, U.S. Economic Outlook and Monetary Policy Speech by Mr. Richard H. Clarita. Vice Chairman of the Board of Governors of the Federal Reserve System, at the Washington Policy Summit. Sponsored by the Institute of International Finance, Washington, D.C., April 11, 2019. Monetary policy efficiently and effectively. Yanis Sternouras, Recent Economic and Financial Developments in Greece speech by Mr. Yanis Sternouras. Governor of the Bank of Greece, at the 86th Annual Meeting of Shareholders, Athens, April 1, 2019. Environment, the slowdown of world trade amid rising protectionism could dampen export growth. ECB, decided in March 2019 to maintain accommodative monetary policy by keeping the key. ECB interest rates unchanged until the end of the year and by launching a new series of quarterly targeted longer-term refinancing operations, TLTRO 3, with a maturity of 2 years. Options provided by the improved legal and regulatory framework. Which has removed significant institutional and administrative impediments to NPL reduction. Insurance-based investment products. In greater detail, the permanent return of the Greek state to international Financial markets on sustainable terms is the greatest challenge ahead. Very low fertility rate. Knowledge, skills, personal initiative, mobility, flexibility, and cooperation will play a key role. Yannis Sturnouras, Lessons from the Greek Crisis, Past, Present, Future speech by Mr. Yannis Sturnouras. Governor of the Bank of Greece, at the 87th International Atlantic Economic Conference. Lessons from the Greek Crisis, Past, Present, Future, Athens, March 28, 2019. Streamlining budgetary procedures and increasing fiscal transparency. At the expense of growth-enhancing reforms, tackling tax evasion and reorganizing the public sector. A bold program of structural reforms was implemented, covering various areas. Such as the pension and healthcare systems, goods and services markets, the business environment. The tax system, the budgetary framework and public sector transparency. The risk of depreciation of human capital, see Blanchard and Summers, 1986, and Moller, 1990. And the low potential growth rate, due to the loss of human and physical capital during the crisis, see Bugvuddy and Hamada. (1974), on the effect of brain drain, coupled with population aging and a very low investment rate. Helping to reduce the investment gap, FDI promotes closer trade links with countries and companies with state-of-the-art technologies and facilitates participation in global value chains. Resort for member states, when they cannot access financial markets on sustainable terms. Emersch, Competitiveness of Europe and European Financial Markets Panel contribution by Mr. Emersch. Member of the Executive Board of the European Central Bank. At the 30th edition of the workshop The Outlook for the Economy and Finance, Villa d'Este, Cernobbio, April 6, 2019. Reap the benefits of the single market. Inefficient withholding tax collection procedures, legal inconsistencies and uncertainties. Fragmented corporate actions and general meeting processes, more harmonization. Of national insolvency rules is needed to make European resolution more effective. John Nicolaisen, will debt be reduced? Speech by Mr. John Nicolaisen, Deputy Governor of Norges Bank, Central Bank of Norway. At the Norwegian Academy of Science and Letters, Oslo, April 9, 2019. ****** Accompanying slides of the speech. Whydo we have debt. Nearly 50 years ago, on December 23, 1969, Phillips Petroleum informed the Norwegian authorities of a major oil discovery on the Norwegian shelf. When it came time to develop the shelf, the Norwegian government decided to invest through direct ownership, financing its direct investment in oil activities with foreign borrowing. Between 1973 and 1979, Norway's public debt soared, and Norway's current account deficit climbed to more than 10% of GDP. The project was risky. Up until 1972, oil prices had hovered around $2 per barrel. The cost of producing Middle Eastern oil was a fraction of this. while production costs in the North Sea were far higher. Even so, the Norwegian authorities took a chance and started to develop the North Sea with borrowed capital. Today, it is safe to say that this decision was a good one. Why do we borrow? The fundamental reason is that borrowing, credit, makes it possible to bring forward consumption and investment. Credit enabled Norway to finance its investment in the oil sector. Credit enables consumers to buy a home early in the life cycle rather than waiting until middle age. Credit can be used to finance education. A car and a place to live while we are young, and enables us to enjoy the benefits while earning money to pay for them. Over the past century, a modern financial system has evolved that provides ample access to credit. A well-developed credit market is an important part of a well-functioning economy. There is another side of the coin. Once we have incurred a debt, it remains with us. The debt must be repaid, with interest. We might say that while credit is an unvarnished good, debt is a necessary evil. Paying for bread already eaten can be tough. When we borrow money, we draw up a repayment plan with the bank. Implicit in this plan are a number of expectations regarding our future earnings, net worth, and interest rates. If these expectations pan out, the plan succeeds. We arrive at the desired outcome. And many times, the future turns out even better than expected. In recent decades, house prices have risen, and with them our wealth. Income growth in Norway. Has been high and has benefited nearly everyone. At the same time, interest rates have fallen to historically low levels. This has made a high debt burden easier to bear. Informing our expectations. We often look in the rear-view mirror. As anyone knows who has driven a car, mirrors are important. But if you only look back in the mirror, you will land in the ditch. That is also the way it is with expectations. If we become overly concerned with past events, we may miss signals about what lies ahead. So the question we must ask is, is household debt in Norway based on unrealistic expectations? Will debt be reduced? How did we get here? Revenues. This year, transfers from the fund account for 1/6 of central government spending. On the other hand, private debt is high, both from a historical perspective and relative to other countries. Chart 1, Record high private debt. This chart shows private debt in Norway relative to GDP all the way. Back to 1830, a period of nearly 2 centuries. We see that debt has multiplied. The average debt of households is more than twice their disposable income. This debt comprises mostly residential mortgages. For those under age 40, average debt is well over 3 times their income. How did we get here? Between these countries and Scandinavia, there are some institutional differences. Housing markets, welfare programs, and pension systems are organized differently. In addition, history and culture may play an important role. Perhaps, in view of recent history, German households are more savings-prone. than others. Elsewhere in Northern Europe, private debt, and household debt in particular, has risen sharply in recent decades. Our part of the world became the champions of globalization. We had the winning combination. Highly educated labor, open economies with access to a large European market and, in Norway's case, abundant natural resources. Our group of countries is characterized by solid government finances. Public debt has fallen through the entire period under consideration. At the same time, the countries in Northern Europe have amassed substantial financial assets. Either in public or in private hands. Chart for substantial wealth, different. Composition. We often think that Norway really stands out, with its big sovereign wealth fund and substantial external assets. But along many dimensions we are actually fairly similar to our closest neighbors. Sweden. Denmark and the Netherlands also have considerable savings. In these countries, however, saving takes place in private pension funds. Throughout Northern Europe, pension savings entitle us all to a future income flow. Whether the saving takes place in a public scheme or through compulsory pension agreements. The security this entails also enables households to bring forward a considerable portion of their consumption by borrowing. And to do so willingly. Together with solid income growth and low interest rates. This has fueled a systematically faster rise in private debt levels than in income. Households with faith in the future borrow and invest. We borrow today. Because we are confident that the income will come tomorrow. How can debt be reduced? While the financial crisis in 2008 brought debt growth to a sudden halt in some countries. Debt growth continues to outpace income growth for Norwegian households. This can hardly go on forever. If debt needs to be reduced, the question is how.